On today's show, Tesla and Broadcom take us to the promised land, what's in store for the market next week, the best index to invest into in 2025, and why this chart could make or break gains for next year. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were very mixed to slightly down here on Friday and on pace for its first weekly decline in 4 weeks. Not a lot to love here today. A couple of bright spots here in healthcare, but I think this is sort of just like a dead cat bounce because much of the space has been left for dead since the election. Tesla was up 4%. There was some news in that front. AVGO on its earnings up 24%. Palantir up nearly 4% and PayPal up 1.9% for the day. And that was really it in terms of green. Other than that, markets saw declines across the board. The S&P 500 was actually kind of flat in returns here for the day. The best performing sector being XLY on the back of Tesla, XLK on the back of AVGO, and then healthcare with their dead cat bounce. And then we saw utilities somewhat of a defensive trade flat today. And then every other sector lost, the worst performing sector being XLC, materials, energy, real estate, industrials, financials, highly cyclical, non-tech levered stocks really took it on the chin today and really took it on the chin this week. And across the board, stocks declined except large cap core. They were up 0.55%. Every other sector and factor and size segment lost. Mid caps, smalls, value growth everywhere was pretty ugly, pretty red today. And market breadth continued to deteriorate. We saw the 5-day moving average lose its 50% mark yesterday. Same with the 20-day, and breadth actually continued to deteriorate today. Longer term, medium term averages still look very, very strong, but it's very clear we are seeing a deterioration here in the 50-day, 100-day, and 200-day moving averages as well. Now, looking at market movers, AVGO was up 24%, breaking $1 trillion market cap. One of a select few stocks to actually go ahead and actually do that. Very bullish momentum in this name. Now, they recorded earnings that beat expectations, revenue that was roughly in line, and the results were decent with Broadcom's strength coming from stronger AI revenue. That's exactly what investors want to see in these semiconductor earnings. And what really jolted investors to buy the stock after its earnings was some commentary the CEO made. And he said, we see opportunity over the next 3 years in AI as massive, alluding to the fact that AI revenue is actually going to continue to grow from here. And that's why the stock was up 24%, breaking $1 trillion in market cap, and was one of the only names that helped lift the Nasdaq 100 today, along with Tesla. Tesla ripping today up 3% when the broader market was red after Trump's transition team recommended repealing a requirement that car makers report automated vehicle crash data. And it really pays to be in the corner of the president. Tesla was up 3%. And another stock that also bucked the downtrend we saw in markets today was PayPal. And that's because it got a huge upgrade from Wolf Research, the analyst being Gary Pella. He upgraded PayPal to outperform, saying there is lots of room for fundamental growth and improvement going forward. He says we see a strong Q4 results and a conservative financial year 25 guide. We believe PayPal's February Investor Day will highlight a path from 4% gross payment growth to high single-digit growth payment growth in 2026. And this will see revenue reaccelerate and the stock to increase to $107 per share in 2025. So he sees about 20% upside from the current price. Analysts are pounding the table on PayPal right now. I've been saying this is a buy since the $60 mark. And look, now everything's coming full circle, up 1.8% today. Very, very strong performance, relatively speaking to the market, which for the week was actually very, very ugly. Price action saw most sectors move lower into this week. Very consistent downtrends from the highs we made here on Monday. The only two stocks bucking the trend being XLY and XLC on the back of Tesla and Google. both rallied and that they kept the relative sectors up. However, the S&P 500 fell for the week, and so too did every other sector from staples, tech, financials, materials being the worst, down 2.85%. That had to do with some of the China situation as well as rates rising on inflation concerns with the PPI data we got on Thursday, and then we saw energy, industrials, real estate. All in all, a very ugly week with bad breath. But to be honest, it's to be expected, because when you look at S&P 500 seasonality, the second week in December, right, we see seasonality actually point downward in the second week of December, and this actually sets us up for quite the turn into the end of the year. In the last 2 weeks is one of the best time periods to hold stocks for the year. So the actual momentum we're seeing in the market that we saw this week is seasonally normal, historically normal, as you can see right here. And it just leads us into what will be an exceptional run into the end of the year. I am bullish for these last 2 weeks, and I think we should see this momentum continue into the first and second weeks of January as well. So guys, stay the course, buy the dip, hold, because we are about to enter the most bullish seasonal time period of the year. But let's hop on the charts. And this is the weekly chart of the S&P 500 the last 5 days. And you can see we pretty much had down to flat returns, very choppy action. We had some very big movement here after the CPI data, and then downward momentum from the highs on the back of the PPI, yields moving high, and just some of the news events we got in the market. Nonetheless, the S&P 500 was down for the week, but let's compare it to the other indices, the QQQ. Let's look at the IWM. We'll add the Dow Jones in here as well, and then the RSP, the equal weight S&P 500. And you can see some very, very interesting developments. Now, the Qs actually gained here on the week. Very interesting, up 1%. That's coming off last week, which was a very bullish week. So absolute alpha from the Nasdaq 100. And there was some bullish momentum in stuff like Tesla, Google as well, Nvidia, Broadcom. They really did outperform this week and lifted the overall market. The S&P 500 down 0.52%, but other than the large cap market cap weights, there was a pretty ugly day in the broad market. The Dow Jones on the back of stuff like UnitedHealth falling 1.93%, the equal weight falling 1.91%, and the IWM small caps down in a very big way, 3.11% in the last 5 days. So a very ugly week, but again, seasonally normal, because what normally happens is around this time period, sort of the 16th, 17th, and 18th of December, we actually put in that seasonal low for the month and then go into the next 2-week period, which is the most bullish time period of the year, the most bullish 2-week period, apart from maybe 1 week in July. So this should be fuel for upside momentum into the next couple of weeks. But let's actually hop on the charts and have a look what we did today. Now, the Nasdaq 100, guys, was up 0.76%, very bullish momentum. We saw the IWM, the RSP all lose, very downbeat price action here in the after hours. And yeah, Broadcom and Tesla really just holding up the Nasdaq 100, because we saw down days in pretty much all of the other stocks. Meta, Google, Nvidia, they were all down. So Broadcom's gains and Tesla's gains really holding up the S&P 500 and the Nasdaq 100, which was flat and up 0.76%. Mid caps saw declines today, same with profitable small caps, and yields did rise on the back of the inflation concerns, especially with the PPI data we got and just a stronger, robust economic data we've got. The market is getting a little bit concerned of a reacceleration in inflation, and because inflation isn't going down, and because the path now isn't flat, it's actually sideways in inflation, in some metrics actually ticking up. So the market concerned about inflation, and that's why we're seeing yields rise ever so slightly. The dollar was flat, and then commodities actually fell as well, because when yields rise, that makes cash more attractive because of the interest they get. It makes commodities less attractive, and that's why gold fell, silver fell, and then crude will always buck the trend because it's a very, very weird asset class. But let's actually dive into the S&P 500, right? Go up here and look at where we stand on our gamma chart. Let's flip this to candles. Let's go on the year-to-date chart, and we can see where we stand right now. So for all of the commotion we saw this week, all we really did this week was actually trade slightly down. But if you look at it in the last month, the S&P 500 is up in a very big way. And to be honest, this right now just looks like very, very mild consolidation after what has been a pretty fantastic rally in the last couple of weeks. Now, we are still in positive gamma. That's very, very positive. And that means our upside target continues to be the 6120 area, the core resistance here. So what we should really see is a bottom put in over the next couple of days and then a rally higher. And we did did see the bears come in a very big way. If we actually just go to the 1-day chart here for the S&P 500, yes, we did see a pretty steep move, right? But we actually did put in a bottom, and we actually sort of made higher highs, higher lows, a little bit consolidation here towards the end of the day, but we did actually close not at the lows of the day. That's constructive. This could actually be the bottom for the next couple of weeks. We'll see how it pans out on Monday. There could be a little bit of volatility into Monday, but we're really looking for right now in the S&P 500 is a bottom for us to then lift off into the end of the year. And that may be what we saw today, especially with this wick right here. Nonetheless, we are in positive gamma, and there still is upside to the 6120 area for the S&P 500. That'll take us to all-time highs and a great way to end the year. For the Nasdaq 100, similar situation. We're in positive gamma. Very ugly doji candle. They call that a dragonfly doji. Typically at highs, that's a very bearish and neutral candle, but we did actually put in a wick all-time high in the Nasdaq 100, and there still is upside room, all things considered. And this could actually be, again, the low, that dip we're looking for to take us into the last 2 weeks in December. Looking at the RTY, it fell again, and we're getting very close to the put support right here. You know, this is actually where we did put in a bottom and have this fantastic rally. So we'll see if we actually continue to move lower here into Monday. I think that's what's going to happen. I think we're probably going to go ahead and touch this level, consolidate here. And if we do hold it and then move up, this will be a stellar buying opportunity for an end of year run. Normally, the small cap seasonal period actually goes from now up until March. Pretty much this week here in December, from next week, when small caps rally, they just absolutely move to the upside for the next three to 4 months. So guys, if we do get a move here to the put support and we do see some consolidation, buy that dip, because small caps are going higher, and it's one of the most bullish asset classes I'll have. And if we do actually put in a low higher than this low, that would be very constructive. And then if we go ahead, break out some of the highs, that would just signal trend continuation. To be honest, I think the Russell 2000, the RTY, small caps, profitable small caps, quality small caps are going to outperform the S&P 500 in the next 2 weeks. I think there's some very bullish momentum, especially if yields do act long. If we get that rate cut with the FOMC, a ton of catalysts next week, but it could be bullish catalysts and bearish catalysts. It just depends what the sentiment is going into those prints and what the actual prints are. All in all, I remain constructively bullish for the next 2 weeks. We're going to squeeze out these last bit of gains for 2024, and then we'll go higher from there. The RSP, guys, very, very ugly when you look at it, but this is probably the place you want to buy. You know, support turns to resistance. This is probably where we want to see consolidation and then make the next move higher. I think this cannot continue. This was just like the RSP moving in a down tape, ugly trading. It's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 trading days, 2 calendar weeks of just the RSP moving down. But I think it's time that we actually move higher from here. That's my prediction. I think the RSP and the RTY are going to see some pretty good outperformance into the end of the year. That's not to say the S&P 500 and the Nasdaq won't outperform. They have room to run to the upside, but I'm just saying that alpha is generated probably in the broader market and these smaller names, because these market cap names have probably pulled a little bit of that December seasonality forward. So it's time to play catch up like the broader market has for the rest of the year. You guys know the names that I like: PayPal, Paycom, a contrarian play, Uber, I do like that. Pexa Group, if you're looking at any other names. I do like Google. I still think it's undervalued. My fair value is 220. So those are all individual names you can like, apart from the standard ETFs, CAF, QSML, XHSQ, the Moat Index, the RSP. I like the RSP and the S&P 500. So all we're doing for the next couple of days is looking for a bottom, and then we want to ride the bullish momentum higher in all of the major indices. So buy the dip. And let's dive into sentiment. This is the Fear and Greed Index. And guys, neutral sentiment driving the US market right now. We've seen a push and pull in the markets. We've seen bullish days. We've seen bearish days. And as a result, we're in neutral sentiment. We've seen the large caps hold up the overall nominal price of the index, but underlying breadth is deteriorating, especially in the last couple of days. We'll see how that improvement leads into the last 2 weeks of December. But as a result, those two factors have left us in neutral sentiment. Not a bearish sign. Actually, it can be a bullish sign. Nonetheless, we are still holding here in neutral sentiment despite deteriorating breadth metrics. And for those of you that don't know, the Fear and Greed Index is highly dependent on market breadth. If breadth deteriorates, you see this thing pull back in a very, very big way. And on to another sentiment check, one done by Warrant Pies. He asked, is the S&P 500 more likely to end below 6,500 or above 7,000. 55% of individuals said below 6,500. In other words, people more likely see very average or below average returns into 2025. I always want to take the contrarian bet, and maybe we see 7,000 S&P 500 and beyond in 2025. My 25 predictions will be out in the next couple of weeks, what I think, and the numbers may surprise you. But in the here and now, not looking to 2025, we see we are about to enter the most bullish time period of the year, the second most bullish 2-week period in the year. Apart from the first half in July, the second half of December tends to see average returns of 1%. That's very, very bullish. And it's not just December. We are actually leading up into the first half in January and just an overall very bullish period into the first half of April right here, which is the third most bullish time period of the year. So seasonally, guys, things can get crazy, particularly to the upside, because we have these seasonal flows as a tailwind for the S&P 500. And here is an equity research note from Jefferies. They see the Russell 2000 outperforming the S&P 500, gaining about 13.5% to the 27,150 area. We look for the small cap losing streak versus large to finally end. We think the election was the last clearing event for smalls versus large. And with that out of the way, we are even more positive versus large caps. H-wise spreads are close to 2007 levels, and we think the balance sheets are way better today. The Fed easing cycle helped small caps, and if borrowing costs continue to fall, albeit moderately, this boosts large versus smalls. M&A has been strong the last 2 years, but much of the deal activity has been in the names below 1 billion. We think M&A accelerates further, broadens out, and draws in the animal spirits to the size segment. We need 25 earnings growth to be better than large caps, or the ball unwinds. The street is looking for smaller to be better than large by the second quarter reporting season, and we are optimistic. So all in all, very bullish based on M&A and earnings, as well as the Fed's easing cycle to propel small caps even higher than what they are right now. Double-digit growth coming from Jefferies. Now, they actually have their sector themes for 2025. They say we're going to upgrade industrials to overweight, they market weight technology, downgrade real estate to market weight, and they keep overweight on energy, materials, and healthcare, and they underweight discretionary utilities and comm services. So all in all, place you want to be is these small cap sectors: energy, materials, healthcare, biotechs, right? Industrials, a ton of industrial stocks in the Russell 2000. So the same sectors that should work into 2025 coincide with the small cap sectors. So all in all, small cap should do really well, but there's a lot of things that need to go right, and we'll see if these companies can deliver the pudding. Now, looking at overall market expectations for rate cuts, because this is something small caps hinge on, looking at the futures market implied probabilities, we see quite a number of rate cuts, but then pretty much stagnant into 2026. The FOMC projections see a very steady rate here of rate cuts, and then you actually look at Morningstar's forecasts, they're actually very dovish, and they just see consistent rate cuts throughout 2026, and they see a terminal Fed funds rate of about 2 to 2.5% right here. So Morningstar, very, very dovish or bullish on rate cuts, even more so than the market and the FOMC projections. So we'll see who's right. The truth is probably somewhere in the middle, and I would say look at the FOMC projections if you want to remain more conservative. But with rate cuts on the table, earnings set to accelerate, where does that leave us with price targets for individual sectors? Now, a bottom-up price target for the S&P 500 sees 9.8% growth in total. That's actually pretty good. That's about the average return for the S&P 500 in the last 50 years. But the best sector in terms of analysts' expectations is healthcare. They see 19.7% earnings growth, followed by materials and energy. And if we actually go back to the chart with Jefferies, they actually overweight energy, materials, and healthcare for 2025. So very interesting to see that their upgrades align with analysts' expectations. They also see utilities and information technology, as well as real estate reporting double-digit growth, industrials to come in at 10%, and the worst performing sector being the discretionary space, comm services, and financials, all reporting well under the S&P 500 of 9.8%. So the place you want to be, according to analysts, healthcare, materials, energy, and utilities, as well as information tech as a whole. I'm assuming that means semiconductors. But should you really trust analysts' expectations? And you should take it with a grain of salt. If you actually look at the 10-year realized annual returns versus projected, you can see that the S&P 500 has really outperformed projected analysts' expectations through most of the last 2 decades. You can see that this is projected returns and this is realized S&P 500 returns, and we've generally always returned greater than market expectations. But what about going into the political environment we're seeing right now, which is a Republican sweep, the Senate, House, and electoral branch all being Republican? On average, equities returned about 7.7%, real GDP came in at 2.79%, and CPI was at 0.47% seasonally adjusted. So we saw very mild equity returns and pretty robust growth and lower inflation overall. I would call it in the middle road, nothing spectacular. The best returns we've ever seen was when we had a Democrat president, a Democrat Senate, and a Republican House. When we've had that, the S&P 500 returned 15.6%, but we had materially lower GDP and higher CPI, so take that with a grain of salt. And diving into the macro, looking at the overall macro market cycle and where we are right now, we are currently in this recovery phase according to BOFA, moving into the boom phase, which should see commodities outperform, higher rates, as well as higher EPS. That should bode well for stocks, but ultimately you want to transition your portfolio from stocks into commodities, and that's why we probably see stuff like energy and materials overweight from Jefferies, as well as the analysts, because they do see probably us going from a recovery into a boom cycle, and that should really coincide with a bear steepening and commodities outperforming as a result, as well as equities. Particularly if EPS is rising, stocks should do really well, but you're gonna have to really choose your stocks wisely. Looking at the overall macro picture with regards to rates, something that's very interesting, mortgage rates fell for the third straight consecutive week after fresh economic data kept expectations about the Fed's next interest rate cut intact, that being the CPI and PPI data. And although PPI headline was hotter than expected, core came in line. We're still expecting a rate cut next week, and the average 30-year mortgage rate fell to 6.6% in the week through Wednesday, compared with a 6.69% the week earlier. According to Freddie Mac data, the average 15-year mortgage rate also dropped to 5.84% from 5.96%. The combination of mortgage rate declines, firm consumer income growth, and a bullish stock market have increased homebuyer demand in recent weeks. While the outlook for the housing market is improving, guys, the improvement is limited given that home buyers continue to face stiff affordability headwinds. In other words, mortgage rates are coming down, prices are still high, and that in turn has led to the lowest housing affordability on record in decades. However, with rate cuts on the horizon and employee compensation and disposable income clearly tracking well above the consumer price index, especially on a 1-year annualized basis, that should see affordability improve into next year, leading to the residential market opening up and that part of the economy expanding and driving growth into 2025. And let's talk about earnings next week. We actually have a pretty big week. We have Accenture, that's the biggest name reporting earnings. ACN is really going to move the software and semi space. We have Nike reporting too. Huge expectations on Nike because we had Ulta, Lululemon, these discretionary athleisure and makeup brands reported earnings, great earnings. We'll see if Nike can deliver as well. MU, Micron, again, gonna move the semi space. And then we have Cintas, FedEx, PayAYX, Paychex, Lennar Corporation, General Mills, Carnival Corporation, Heiko, Darden Restaurants, FactSet Research Systems. We have a number of very, very big names reporting next week, but a lot is really going to be on these big 4 or 5, particularly with Accenture Software, Nike, the discretionary space. We have a semi-name reporting, FedEx from the consumer. We also have Paychex, I own Paycom, literally a competitor to Paychex. They're reporting, and then Lennar Corporation, a home builder. So we got a whole range of earnings next week. It's going to be a very big week, but not necessarily for earnings, but also on the data front. Now, this is a huge week of data. In fact, so huge, I had to put it on 2 separate slides. A big week of data coming up, guys. We kick things off with PMI, manufacturing services, and composite numbers. No rest for the weary. On Monday, we have the big manufacturing data. Then Tuesday, we have retail sales, the entire retail sales, industrial production, and that's really it. Then Wednesday, we have building permits and housing starts. Huge. That's totally going to be overshadowed by the FOMC. We get the rate decision. The expectation there is for 25 basis point worth of a cut. Then on Thursday, we get the GDP revisions, the growth rate, as well as the price index. We also get initial jobless claims, more housing data, existing home sales. Then on Friday, we get the PCE, the inflation data, personal income outlays, personal spending, personal income, and then consumer sentiment from Michigan. So a huge week, the biggest week of your life, the biggest week of Jerome's life is next week. And it all kicks off on Monday with earnings, Accenture, and all of the volatility. So guys, be prepared for a very volatile week and a crazy week, and expect the markets to climb the wall of worry. But if you've made it up until here, thank you so much for watching. If you liked the video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.